So, what's going on with Plug Power stock? The stock price is down significantly from the highs near $70 per share in January 2021, down to about $11.51 per share as of this recording. So, what has caused that significant stock price decline? I hope to answer that question in this video, reviewing the company's Q4 earnings call and looking at what the CEO had to say about the company's performance in recent time and its prospects going forward. So, looking at those insights, we should be able to determine what's going on with Plug Power stock. So, let's get into the details. You're not going to want to miss this. By the way, this was on March 1st, 2023, that the CEO held this earnings call with Wall Street investors. He starts off by saying our performance did not meet our expectations. We attribute this primarily to three factors: obstacles well encountered while introducing new products, lease in constructing the hydrogen plant, and macroeconomic conditions that affected the cost of natural gas, resulting in a significant increase in the cost of our hydrogen. So these three factors all played a role in Plug Power not meeting expectations. And you have a company like this with very lofty growth expectations with very high prospects for the future. I mean, the company expects to like something like 20x its revenue over the next 6 years. So anytime you have a hiccup in terms of the progress on that front, you can have big fluctuations in the stock price. So these are important to check with the progress of the company's performance, and it's more so because they have such lofty growth expectations that they're going to need to meet these milestones every quarter and every year to keep investors interested and keep investors confident that they can achieve their long-term targets. So let's go on here. The CEO says Plug is actively pursuing every aspect of the hydrogen economy, right? Like I mentioned, lofty expectations, very ambitious goals. One of our major advantages is the distinguished list of customers, including Amazon, Walmart, New Fortress Energy, and great partners like South Korea and Renault. So undoubtedly great partners, great relationships with these partners that are eager to get Plug Power and its renewable source of energy into their enterprise and into their institutions, because energy is a big part of what all of these enterprises and institutions are needing right now. So, moreover, our growth plans are supported by a policy environment that promotes renewables. No doubt about that. Nearly every government in the world, I say nearly, not all, most governments are emphasizing the growth of renewable energy, right? Especially the US and Europe. So, the USA had the major investment plan that's going to funnel billions of dollars into renewable energy and electric vehicle growth and all of that. That supports Plug Power, and Europe had the Repower Europe initiative that's helping support that. So they've got a strong secular tailwind behind pushing them, encouraging them, and helping them move forward. So their first green hydrogen plant in Georgia is set to begin hydrogen production early this year. However, this is just the start of our plan to expand our production of 500 tons per day across the United States by 2025. Ambitious goals: they expect to get to 200 tons per day by the end of 2023, and then from 200 to 500 tons per day by the end of 2025. So I'll be following this, checking up on them, seeing if they're meeting these targets, because it will be very supportive to the stock price if they can meet these targets and stay on pace. And if they get behind, it can be detrimental to the stock price. Part of our aggressive strategy, we will also provide products such as our electrolyzer platforms, base products for EV charging and peaker plants. We're also developing on-road vehicles through our JV partner Renault. So they're going, like they mentioned, all parts of the hydrogen economy. They are trying to reach every end customer, and this requires massive investments and long-term plans. So investors will be looking for this company to continue growing for several years, maybe even several decades actually. We believe that our manufacturing and supply chain capabilities are crucial differentiators in our industry. So this is where they expect to have the core competency, the competitive advantage is in manufacturing and supply chain capabilities. And at Plug, we placed a high priority on the advantage of large scale manufacturing, large scale. So they're going big, they're starting big. They're not doing the incremental approach. They're starting off with big, massive investments in manufacturing, in capacity. And when you start big, that allows that's a greater degree of fixed costs and a lower degree of variable costs, which lowers the cost of production per unit, and you're able to sell at a lower price per unit if you can effectively scale that capacity. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So by the end of 2023, we aim to generate $1.4 billion in revenue, and they aim to clearly demonstrate the profitability for all our investors. And I think the second point there is going to be the more critical point for 2023, because investors, the market overall has become less tolerant of unprofitable growth stocks, and just these lofty, ambitious growth projections used to get the stock rising in 2020 and 2021. That hasn't worked in 2022 and 2023. That can partly explain why Plug Power stock has declined significantly, right? So this second part, to clearly demonstrate profitability, even if they're not actually profitable, if they can demonstrate a plan, a progress, a meaningful step forward in progress towards profitability, that will be something significant for investors to digest and perhaps lift the stock price higher, even if it comes at the expense of slower revenue growth, of slower rolling out of these manufacturing of these energy productions, energy plants, right? Even if they have to delay the, let's say, the 200 tons per day by the end of, let's say, instead of by the end of 2023, they do that by the end of 2024, because they say that, oh, it will be more cost effective if we do that, and we can achieve better profitability if we are to do that. I think investors might take that well. I think investors might take that well, because profitability and cash flow is becoming a lot more imperative. And it's not just that the market psychology doesn't want to, take on that unprofitable growth stock. It's also that the cost of capital has increased. The cost of capital has increased. So if you're looking at generating cash flows, not being cash flow positive until, let's say, the year 2027, now when you're discounting those cash flows back, we're using a higher cost of capital, which is then putting a lot of pressure on the stock price. So if you can move forward those cash flow projections, that will improve the stock price just because of the cost of capital. So based on my experience, design issues that were not initially considered often arise within the first 6 months, and supply chain and manufacturing challenges tend to emerge during the first year. So it's nice that the CEO is being transparent and saying, look, we're in an innovative space here. Some of the things we're doing have never been done before. So we're going to face some difficulties. We're going to face some challenges. We're being upfront with you about that and letting you know that it's, and here the CEO goes on, I can confidently say it's unrealistic to expect flawless product launches. However, we believe that our plans are achievable and we have built in some buffer or margin of safety in our projections for 2023. So remember, 2023 they said 1.4 billion in revenue. By 2026, 5 billion in revenue. By 2030, 20 billion in revenue. So between 2023 and 2020 and 2030, that's nearly 20 times growth there, from 1 billion to 20 billion. And so like I mentioned, very ambitious growth projections, and lofty goals. There's going to be some hiccups along the way, but the CEO is saying that we've already accounted for those hiccups and those challenges when giving you these long-term projections and long-term outlook. So very interesting company, very innovative, on the cutting edge here, and very long term projections. And you can understand why the stock price is down, because the market is not excited about this kind of unprofitable growth company that's investing a lot of money right now and over the next couple of years, with the potential for becoming something huge, but it's just so far down the road, right? You're looking at 20 billion in revenue potentially, but 2030, that's so far down the road, right? 7.5 years down the road. So that's a long time. And with the higher cost of capital, discounting those cash flows all the way back to today really lowers that valuation. And you can understand why the stock is down. And then on top of that, when you put the fact that the company had a lot of headwinds in 2022 impacting their plans, and that was not good news either. So it's going to be volatile. The stock price is going to move up and down. It's going to have violent fluctuations up and down on a quarterly and even on a monthly basis, as new reports come out, as news comes out, as macroeconomic conditions change. The implications for this stock are going to change as well, and more so than any other, more so than the average company, because their cash flows are so heavily weighted so many years into the future. And so it's impacted more significantly from slight changes and changes in the cost of capital. I hope this has provided a lot of insight into what's going on with Plug Power stock. That's all I've got for this video. I've got some other ones popping up on your screen right now that I think you will enjoy. So please click on one of those and I'll see you over there. Thank you for watching.